In the last few years, private credit has steadily risen in popularity as a growing number of investors have embraced investment avenues that could counter low returns in traditional debt products amid surplus liquidity and low interest rates. The alternative investment industry has been gaining traction and is poised to position India as an investment hotspot for the global investor community, including non resident Indians. Now, broadly, India has also made the headlines in 2022 by overtaking the UK economy in size. And with the country steadily moving towards the $5 trillion economy mark in the next few years, this trend is expected to grow stronger. The industry that spans portfolio management services and alternative investment funds is expected to find more takers as India is now among the most vibrant emerging markets in the world. And growing numbers of high net worth and ultra high net worth individuals that could also catalyze this expansion, plus strengthening regulatory support and the availability of a wide array of asset classes will also flavor inflows. Today, though, ladies and gentlemen, we shine the spotlight on credit funds to help you understand this landscape. I'm your host, Gautam Srinivasan, and guiding us through this topic with her insights is Sunaina daCunha, who's the co-head of fixed income credit at Aditya Birla Sun Life Asset Management Company. Sunaina, great to have you on board and looking forward to your lessons, your experiences, and your insights on this topic. But first, let's start with your thoughts on the credit funds landscape in India. According to you, what are the key highlights that our viewers should take note of?
Thanks so much, firstly, Gautam, for having me on your show. So if we have to understand the credit funds landscape in India, I think we need to step a little bit back into history because, this is a relatively newer asset class within fixed income. It took birth about 10 years ago. So if I look over the last 10 years, they've broadly been 4 different phases, and I'll take you through that so that we get an understanding of, how we've evolved and as a result, where we are today. The first phase, I would say, is 2013 to 2015. And this is when the industry kind of took shape and got its birth in the 2013 BOP crisis, because immediately after that crisis, we had the Reserve Bank of India come in and insist that all banks clean up their balance sheets. And they introduced, the prompt corrective action framework. They also came up with a lot of other, policies like the large exposure framework, which resulted in a lot of banks, being unable to further lend to their very high quality corporate clients. And these corporate clients then needed to look for another avenue to raise funds, and there were mutual funds sitting over there. And as a result, mutual funds suddenly got access, which was not there earlier for us, to very high quality, good credit. And we actually could credit pick and cherry pick from, the wide array available. So credit funds actually took birth at that point of time as a separate, distinct category investing in corporate debt. And I think from there, we've kind of evolved. So if you move beyond that into the second phase of 2015 to 2018, that's really what I would say is the super cycle of the credit cycle that we've seen in India. And this was a period of time from a macro perspective where, post the 2013 crisis, now rates were falling, liquidity was abundant. And of course, you had demon that came in 2016, which resulted in a lot of financialization of household savings and assets. And as a result, you had this whole category of newer investors who had a lot of savings now in a format that they needed to invest. And you also had this new category of funds suddenly available. And the experience thus far had been fairly good, because even in 2015, while some funds in industry did see some defaults caused due to the commodity cycle and some commodity oriented companies, those losses were passed on to investors, and investors took it in their stride, and there was not much of a speed breaker or a bump in this. And as a result, a lot of people got attracted to this category of credit funds. Maybe a little naive thinking that, there's always be easy sailing and smooth sailing. And as a result, we saw a lot of money actually starting to flow into these funds. But also we had a lot of development on the policy front, including the introduction of the IBC code, which made investors, also fairly confident that even if there were tough times ahead or there were defaults, the regulatory framework now protects secured investors and puts them right up in the hierarchy when it comes to recoveries. And as a result, you suddenly had a lot of money chasing, the assets, because a lot of money flew into these funds. The cherry picking philosophy that was actually followed earlier then kind of got diluted a bit. You had a little bit of mispricing happening, slight loosening of you could say underwriting standards, and with so much money flowing in, if you would otherwise have taken a 1 to 2% kind of exposure in your fund, suddenly you were diluted so quickly. So people started taking slightly larger exposures. And I think by 2018, and that's the third phase, which is the credit crisis phase, I think a couple of missteps that industry had taken started coming to the fore. Of course, from a macro perspective, there were macro headwinds. So it was, the making of the perfect storm, because you had macro headwinds come in with rate hikes, not only by the Fed, but also closer home by RBI. And then you had the IL&FS default, the default of a very large group, AAA rated, and the ramifications of that, which we saw, spread through markets with the NBFC crisis that followed soon after. And we saw a series of a lot of large storied groups actually face fair amount of stress. So that's when, in 2018 to 2020, you had a series of these events topped off, of course, by COVID at the end, where, at least in the initial couple of weeks, when that tremendous lockdown initially came in, the markets completely froze. And forget, credit names or AA minus A plus kind of names, even AAA spreads completely blew out. And you had a bit of a liquidity crisis, and that culminated in, a large fund having to stop redemptions in some of its schemes. I think when I look at it from hindsight, the rest of the mutual fund industry did incredibly well, because one, they, were very nimble-footed enough to a great extent to manage to unwind some of the credit that they had built up. They actively managed their credit. And I think funds also were able to manage the huge pressure on liquidity and redemptions that came in the immediate aftermath of that event in April. And, immediately after a fund shut down, its credit-oriented schemes, the rest of the credit funds saw their AUM deplete by 35 to 40% in a span of 2 weeks, and still was able to meet redemption. So I think in hindsight, the funds managed fairly well, which then brings us to where we are situated today. Today, as we're looking at it, the industry has gone through some amount of stress, but a lot of those stress assets have been cleaned up and cleared up. You've had resolutions coming out of the IBC process. Of course, it's taken a fair amount of time, much more time than what all of us initially thought when the IBC framework was initially proposed. But you also have a very new asset class available out there, which are, funds and investors that look to invest in stressed assets. And as a result, the industry has been able, at an appropriate price also to exit some of their exposures that they have. And today, sitting where we are, corporate India is extremely well placed from a credit underwriting perspective, because they've used the last 2 years, 2.5 years of flush liquidity to completely heal themselves, heal their balance sheets. We have seen, corporate credit health being, probably the best that it has been in the last 8 to 10 years when you look at it from any metric. From a credit underwriting perspective, things are fine. From a credit spread perspective, things have been, we haven't had enough spread or enough juice because spreads absolutely contracted given the flush liquidity. But considering we're getting into, a neutral territory in terms of liquidity or tightening liquidity, I think those spreads are now going to start inching up. They're already back at long-term average levels, but, you'll probably start seeing good opportunities come from a risk-return adjusted perspective. And that's why I think in the next 3 to 4 months, that's going to be a time when, credit funds again will find favor and should be looked at, from that perspective.
And it's interesting that you've outlined this sort of decades worth of journey, and it's been a very eventful journey at that. What people might assume that credit and debt might be boring spaces, they've actually been far, far more interesting than the equity side of the story. But I also want to understand in the context of the ups and downs that have happened, as you mentioned, the liquidity picture improved over the past 2 years, which has helped the industry sort of heal itself. But also to understand from you the checks and balances that have been incorporated by regulators and say fund houses with respect to credit funds specifically, because as you are saying that there would be an uptick coming in soon. What are these sort of safeguards that have been sort of incorporated in the interest of investors?
So I think the regulator has brought in a lot of measures, both to protect investors as well as, from a portfolio construction perspective. So from an investor perspective, for them to understand and truly appreciate the kind of risk that they're entering into, we have all these various disclosures that need to be made, be it color coding or the riskometer or the potential risk category. So, to that extent, I think they want investors to truly appreciate the risk that lies in a particular fund. And of course, this is for all the funds, but I think for credit within the fixed income category, it's much more relevant. So that, there is no scope for them to enter a product that they're not too familiar with or don't completely understand the risk. And of course, from a portfolio perspective, they've brought in a whole liquidity framework, which mandates that each fund needs to maintain a particular amount of assets, LRAR, CRAR, those are the codes that we have, to ensure that in case there is, any kind of an outflow, you're in a position to actually meet that. So, that's a fairly complex framework that looks at, not only the asset side in the portfolio that you're actually running, but also the liability side, the concentration that you have investor-wise and distributor-wise. And then, of course, they have stress testing that needs to be continuously carried out on, all the three parameters of fixed income, liquidity, duration, as well as on credit, and a continuous rebalancing in case, those thresholds from a stress testing perspective are met. And then, of course, they have to ensure that fund managers are aligned with their portfolios. There is the skin in game that they have introduced a couple of years back as well. So I think from a regulatory perspective, they have brought in a fair number of changes. I think you asked about mutual funds as well. I think each mutual fund, of course, would have had its own learning, and not only from, their experience, but also looking at the rest of industry. But I would think, mutual funds, if I look at them, have become a little more risk averse compared to where we were. So if I talk about, let's say, June 2018, and I look at the entire industry, not just credit funds, but the credit taken by the entire industry across all schemes, and I consider credit as non-AAA, non-sovereign, non-cash, then the percentage of AUM of the invested in this category of credit was actually closer to about 18-19% in 2018, June 2018, which fell all the way to 9% in, let's say, June 2020, and is currently hovering at around about 14 to 15%. Which means it's actually a 5% negative delta from where we were at the peak of the, what I call the super cycle of credit. And when I look at it from a slightly broader perspective, that actually means on a 16 lakh worth of AUM that, the entire industry manages, assuming that credit in its entirety earns you about a 1% extra. That is a loss to the industry of about 800 crore, which, belongs to investors, distributors, as well as, of course, to AMCs as well. So I think post this, the mutual funds also have become a little risk averse. Of course, everyone would have their own frameworks internally in place. And, the credit underwriting filters always get a little tightened post these kind of events.
All right, let's also look at the dichotomy, because there are corporate bond funds with mostly AAA rated papers and there are credit funds of equal duration. So from an investor consideration perspective, what should investors be considering when they add them to their portfolio? And given the state of the economy, how do you envisage credit funds finding their way into retail portfolios?
So, fixed income has three broad levers: liquidity, credit, and duration. Now, liquidity actually is just a surplus deployment kind of a strategy or tool. But duration actually is more of it's not a structural kind of an investment. It is more a tactical deployment as well. And
Hmm.
that's because, to generate those double-digit returns that, people generally look for when they enter duration funds, because, they're exposed to a fair amount of volatility, they need to time their entry as well as their exit perfectly. If they remain passive investors in duration funds, it's likely that they then get, a seven-centric kind of a return experience. So, you need to be able to enter and exit the appropriate point to actually, get that alpha out of duration. But
Hmm.
when you look at credit, credit is like an all-season bellwether kind of asset class that can always find a place in your portfolio because it earns you that nice thick spread that cushions the volatility that is there, when you look at it from a duration lens. But of course, you need to be very careful when you're, underwriting. You need to be careful to ensure that there's active fund management and active credit management to take care of any kind of a volatility. See, as I said earlier, credit generally earns you about a 1% kind of an extra spread that is available. But if you look at it from a probability of default perspective, Crystal does these studies on, how much is the probability of default over the next 1 year for different rating categories. And if you look at, let's say, an A-rated category, it works out, to about 0.16%.
Hmm.
Now, if you assume that you recover only 25% of that, then you're actually looking at a loss of 0.12% for a 1% exposure that you've taken to this A-rated paper, which basically means that if you're able to minimize, your loss given default, then you should be able to have a reasonably good experience in this asset class. But you need to be fairly patient because it can be volatile if you're holding it through the entire credit cycle.
So, given the patience required, what kind of investors should invest in credit funds? Because it's understood that you will have to give your investment product some time. But typically, when you look at the profile of investors, what are the kind of investors you think should pay more attention to credit funds?
So patient investors for sure. The ones who understand, the fact that there is embedded credit risk in
Hmm.
these funds, and the economy goes through various cycles, including credit cycles. And in a downturn, there are bound to be, some defaults that can potentially happen. So, patient investors, people who are aware of the product and the risk embedded in the product, and people who have at least a minimum 3 years kind of a horizon, because you need to see the cycle through. You need to be patient. See, as I was telling you earlier, when I was talking about the evolution of this credit funds in India, when IBC was introduced in the country, it was expected that resolutions would happen in 270 days because that was the number that was put in the code, in the regulation. But we've seen that, the experience has been, very different from that. And actually, the resolutions have taken much, much longer. So that's why you need fair amount of patience, when investors come into these funds.
All right. Before we let you go, let's look at the way forward, right? So, in the post pandemic economy that we are in, how do you see the credit market growing? Considering there has been intervention from the central bank and the government and taking into account the high risk interest rate cycle, how do you think the credit market is going to perform in terms of defaults? As you mentioned, you need to be patient. IBC regulations, as you said, 270 days, given it takes longer. So it's still early days for this entire market in terms of digesting the investment product. So what's the way forward in your opinion?
So I think, from a corporate credit health perspective, India is very well placed. As I
Hmm.
was mentioning earlier, the last 2 years with the abundant liquidity, companies have, large companies have been able to take advantage of that. They've delevered their balance sheet. They have replaced high cost debt with low cost debt. And they have termed out their liabilities, improving the asset liability mismatches that were there in the past. If you look at it from various metrics perspective, while leverage seems to have gone up in the last 6-8 months, that's more from a perspective because working capital cycles have gone up, and very selectively we've had some amount of capex in few
Hmm.
sectors. But I believe that, going forward, uh, from a credit underwriting perspective, things might still look good. But, all the various stakeholders have learned a fair amount from, the last few years. So if you are, promoters and management also are fairly wary to take on, too much debt. So a lot of the capex that we're seeing being announced is actually, being financed from internal accruals. So gone are the days when you saw debt-laden acquisitions or debt-financed pure greenfield, brownfield kind of expansions. A lot of it, is much de-risked nowadays because promoters have seen, their compatriots in the last couple of years lose their companies, lose their groups in many cases. And nobody wants to make, those kind of errors again. Fund managers, on the other hand, also have that experience behind them. So they also are putting in their learnings into place when, building funds and when investing. So, while I think that, and of course, in every credit cycle, there will be the down cycle and there will be defaults at the end of it. But as long as, fund managers are able to minimize the impact, by actively managing the credit, as well as, ensuring that there's not too much of a concentration risk building up. I think in the long run, the experience should be good. So I think in the next 3 to 4 months, as the spreads start expanding and as, liquidity gets tighter and tighter, you will see fairly good risk-adjusted, returns being possible, when investing in certain papers, and they will find their place in credit funds again. And this category should see a revival.
All right, Sunaina, thank you so much for joining us and sharing with us this roadmap to approach credit funds and the broader universe. Hopefully, it should provide our viewers some food for thought when it comes to added credit funds to their portfolio. On that note, we wrap up this special presentation. Till next time, this is your host, Gautam Srinivasan, signing off. Have a great day.